Every man I know has thought about it. Owning a home. A place that is yours, where you build equity instead of paying someone else's mortgage, where your kids grow up, where you actually put down roots. It is not just a financial goal. It is a deep American dream that most of us grew up believing was the natural next step in becoming a real adult. And then you start looking at the actual numbers. The median home price in America right now is hovering around $420,000. Mortgage rates are significantly higher than they were just a few years ago. Property taxes, insurance, maintenance, costs that nobody mentions when they tell you to just buy a house. And suddenly the dream starts feeling like it is built for someone else. Someone who earns more, someone who started earlier, someone who got lucky with timing. In this video, I am going to give you the real, honest numbers behind buying a home in America right now. What income you actually need. What costs most people never see coming. And whether homeownership in 2025 actually makes financial sense for your specific situation. No cheerleading, no oversimplification, just the truth. Before we talk about your income, you need to understand what is actually happening in the American housing market right now. Home prices have increased dramatically over the past 5 years. What cost $280,000 in 2019 now costs $420,000 or more in many markets. That is a 50% price increase in 5 years, while wages grew at maybe 15% to 20% over the same period. Mortgage rates compounded the problem. When rates were near 3%, a $400,000 home had a monthly payment of roughly $1,686. At today's rates near 7%, that same $400,000 home costs approximately $2,661 per month. That is $975 more every single month. Over 30 years, that is $351,000 more in total interest paid. Supply remains critically low. Millions of homeowners who locked in 3% mortgages years ago have no reason to sell and give up that rate. So inventory stays low, demand stays high, prices stay elevated. This is the environment you are trying to buy in. It is genuinely harder than it was for your parents. That is not weakness or excuses, that is math. Understanding this context is important, not to discourage you, but so that the numbers I am about to share make complete sense, and you stop blaming yourself for finding this difficult. Every mortgage lender, every financial advisor, every serious homebuying guide starts with one foundational rule. The 28% rule. Your monthly mortgage payment, including principal, interest, property taxes, and homeowner's insurance, should not exceed 28% of your gross monthly income. This is not a suggestion. This is the boundary that separates a home that builds your wealth from a home that slowly destroys it. Let me show you exactly how this math works with real numbers. If the median American home costs $420,000 and you put 20% down, your loan amount is $336,000. At current rates near 7% on a 30-year mortgage, your monthly principal and interest payment is approximately $2,236. Add property taxes, average $350 per month nationally. Add homeowner's insurance, average $150 per month. Your total monthly housing cost is approximately $2,736. Now apply the 28% rule in reverse. To afford $2,736 per month in housing costs, you need a gross monthly income of at least $9,771. That is an annual income of approximately $117,000 per year. The median household income in America is around $74,000 per year. That gap between what most Americans earn and what a median-priced home requires is the real reason homeownership feels impossible for so many hardworking people right now. The income requirement is only half of the home-buying challenge. The down payment is the other wall most men hit first. The traditional recommendation is 20% down. On a $420,000 home, that is $84,000 in cash, before you buy a single thing. For most American men earning average wages, saving $84,000 takes years of serious discipline. At $500 saved per month, that is 14 years. At $1,000 per month, 7 years. Now here is where options exist and where you need to understand the full cost of each. Option 1, put less than 20% down. Many conventional loans allow 5% down, that is $21,000 on a $420,000 home. FHA loans allow as little as 3.5% down, around $14,700. These lower barriers make homeownership accessible sooner, but there is a cost. When you put less than 20% down, lenders require private mortgage insurance, called PMI. PMI typically costs 0.5% to 1.5% of your loan amount annually. On a $400,000 loan, that is $2,000 to $6,000 per year, or $167 to $500 added to your monthly payment for insurance that protects the bank, not you. Option 2, down payment assistance programs. Many states offer programs specifically for first-time homebuyers that provide grants or low-interest loans for down payments. These are real, legitimate, and massively underused. A quick search for your state's housing finance agency can reveal options that could provide $10,000 to $30,000 in assistance. Know your options. Know their real costs. Then choose with clear eyes. This is the part of the home buying conversation that most real estate content deliberately skips, because it is not exciting, but it is absolutely critical. Buying a home costs significantly more than the down payment and the monthly mortgage. Closing costs alone, the fees paid at the time of purchase, typically run 2% to 5% of the loan amount. On a $420,000 home, that is $8,400 to $21,000. Due at closing, in addition to your down payment. Home inspection, $300 to $500, non-negotiable. Never skip this. Moving expenses, $1,000 to $5,000 depending on distance and how much you own. Immediate repairs and upgrades. Most homes need something within the first 90 days. New locks, paint, appliances, minor repairs. Budget $2,000 to $10,000 depending on the home's condition. Then the ongoing costs begin. Property taxes, average $3,500 to $5,000 per year nationally, but dramatically higher in certain states. Homeowners insurance, $1,200 to $2,000 per year average. HOA fees, if applicable, $200 to $600 per month in many communities. Maintenance, financial experts recommend budgeting 1% of your home's value annually for maintenance and repairs. On a $420,000 home, that is $4,200 per year, or $350 per month that many new homeowners completely forget to plan for. The real monthly cost of homeownership is almost always $500 to $1,000 higher than the mortgage payment alone. Build that into your planning before you buy, not after. Here is something the national average completely hides. Where you live changes the income requirement for homeownership dramatically. The same income that makes you a comfortable homeowner in one city makes you completely priced out in another. In the most expensive markets, San Francisco, New York City, Los Angeles, Seattle, the income needed to comfortably afford a median-priced home exceeds $200,000 per year. These markets are genuinely out of reach for most American men on average salaries without significant family wealth or years of aggressive saving. In mid-tier markets, Austin, Denver, Nashville, Phoenix, the income needed sits between $100,000 and $150,000 annually. Achievable for dual-income households and higher-earning professionals, but still a stretch for many. In more affordable markets, cities in the Midwest, South, and parts of the Southeast, median home prices are significantly lower. In markets like Cleveland, Memphis, Kansas City, or Birmingham, the income needed to comfortably afford a median home drops to $55,000 to $75,000 annually, much more aligned with median American wages. This is why geographic flexibility, if your career and life allow for it, is one of the most powerful home-buying tools available to American men right now. A $75,000 salary might make homeownership nearly impossible in California and completely comfortable in Ohio. Know your market. And if your market is genuinely unaffordable, have an honest conversation about whether geographic flexibility is an option worth considering. I want to address something directly because too many people in personal finance treat buying a home as automatically superior to renting. It is not always true. The rent versus buy decision depends entirely on your specific numbers, your timeline, and your life situation. Arguments for buying: you build equity with every payment instead of paying a landlord. You have a fixed mortgage payment that does not increase the way rents do. You have the freedom to customize and renovate. Historically, real estate appreciates in value over the long term. Arguments for renting. In expensive markets, renting is often significantly cheaper monthly than owning the equivalent home. The money saved on the down payment, if invested consistently, can outperform home equity growth in many markets. Renting provides mobility, critical for men whose careers require geographic flexibility. Renting means zero maintenance responsibility and zero surprise repair bills. The financial break-even point, how long you need to stay in a home before buying outperforms renting, is typically 5 to 7 years in most markets. If you are not confident you will stay somewhere for at least 5 years, renting may genuinely be the smarter financial decision, not the weaker one. Buying a home is not automatically winning. Renting is not automatically losing. Both are tools. The right tool depends on your income, your market, your timeline, and your life goals. Let me bring everything together, your complete home readiness plan. Step 1. Know your real number. Using the 28% rule, calculate the maximum mortgage payment you can afford based on your current gross income. Then work backward to find the maximum home price that fits that payment at current interest rates. This is your honest budget, not what the bank will approve, what you can actually sustain comfortably. Step 2. Check your credit score today. Your credit score directly determines your mortgage interest rate. The difference between a 680 score and a 760 score on a $350,000 mortgage can mean $50,000 to $80,000 more in total interest paid over 30 years. If your score needs work, work on it before you apply for anything. Step 3. Build your full down payment target. Decide whether you are going 20% down or using a lower down payment program. Research your state's first-time homebuyer assistance programs. Start a dedicated down payment savings account today, separate, automatic, untouched. Step 4. Build your emergency fund separately. Before buying a home, have 3 to 6 months of expenses saved in addition to your down payment. Homeownership brings surprise costs. Going into a home with zero financial cushion is how men end up housepoor, owning a home but unable to afford anything else. Step 5. Get pre-approved before you shop. A mortgage pre-approval tells you exactly what you qualify for and makes you a serious buyer in a competitive market. Shop at least 3 different lenders. Rates and terms vary significantly. Step 6. Add up all the real costs. Down payment plus closing costs plus moving expenses plus immediate repairs plus first year of maintenance. This is your true cash needed to buy. Make sure you have it fully before you close. Homeownership in America is harder than it has been in decades. The income requirements are real. The costs are real. But for the right man with the right income, the right savings, and the right market, it is still one of the most powerful wealth-building moves available. Go in with clear eyes. Go in with real numbers, and go in ready. This is Money 23 Hub, real financial truth for real American men every single week. Subscribe now. Like this video if the home buying picture just became a lot clearer. And comment below, are you currently renting or saving to buy? I read every single comment. See you next week. Let's build something real.